Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. I'm sure you must have heard the inflation news in the US, which is spooking investors and consumers alike. Apparently, the inflation in the United States has broken a 30-year record and is now being seen at around 6%. Of course, for us Indians, 6% inflation, is par for the course. We are pretty much used to it. But this is US. We are talking about developed nation, but people have not seen inflation much beyond 2-3%. So for them, the inflation to reach the 6% mark is pretty scary, and quite understandably, it sent shivers down the spine of the US stock market. The day this inflation news was announced, the US stock market was, I think, down some 1%. According to some experts, though, this is just a passing storm. It's a result of the supply bottlenecks, the supply constraints that the US economy is facing. And the inflation numbers, according to them, should normalize again and should go down. But for some, other group of investors or other experts, this is the chickens of the loose monetary policy and the loose fiscal policy that are finally coming home to roost. The US, as we all know, is running a very loose monetary policy where interest rates are almost zero. It provided a huge fiscal stimuli right after the pandemic to sort of prevent the economy from going into a tailspin. So this is the effect of that, and they see this to be persisting, the high inflation rates to persist unless the US Fed intervenes and accelerates its tapering program or raises interest rates at a pretty fast pace. Therefore, this definitely will be a key indicator to watch going forward. Now, as far as India is concerned, inflation is not a concern in India, at least right now. It's well under control. But you never know such things. I mean, a spike in commodity prices like crude oil, natural gas, and the kind of interconnectedness that we have in the global economy, a lot of the inflation concerns that are arising in the West could spill over into India as well. And in India also, we could see a rise in inflation. So a higher inflation regime is definitely a concern for consumers. It raises the cost of living. Everything becomes expensive. It causes a sort of dent in our savings. But should it be a concern for an investor? If we are moving from a low inflation regime to high inflation regime, should our investment strategy change? Should we approach investments differently? Now let's try and find answers to this question in this video. To begin with, which is a better defense against inflation? Is it stocks or is it bonds? Since our expertise here is stocks and bonds, we'll restrict to these two asset classes only and not talk about other asset classes. So what is a better defense against inflation? Is it stocks or is it bonds? Now, historically, if you look at the inflation, I have the data going back 30-35 years, and inflation has hovered around 7 to 8%, around 8% to be more precise. FDs, on the other hand, fixed income instruments, they've also given close to 8% returns on a CAGR basis. So if you would have invested your entire corpus into FDs or into bonds, you would have managed to break even. Stocks, on the other hand, have proven to be a fantastic defense against inflation. The Sensex is up 600 times in the last 40 years, a CAGR of 16-17%. So you have an inflation rate of 7-8%, and you have stocks which have given 15-16%. So according to this, it's a no-brainer, right? I mean, you have an asset class that has given twice the rate of inflation, and therefore whether inflation is at 4-5% or whether it's at 7-8% doesn't matter. Even if the inflation rates go up from here, even if we enter a high inflation regime, stocks should prove to be the best defense against inflation. So from the point of view of this study or this data, it's chapter closed, right? I mean, there is no doubt that stocks will prove to be a better defense against inflation because historically they have given 14-15% returns and they're likely to do so going forward as well. Well, but there's a small glitch here. The small glitch is the assumption that stocks have an inbuilt protection against inflation. That is not the case. Intuitively, it's very easy to say that in a high inflation environment, stocks are bound to do well because if the prices of goods and services go up by 7, 8, 9%, companies are able to record better profits. But when I looked at the data, when I studied the historical data, that does not seem to be the case. Now, if you look at the slide that's there on your screens right now, between 2001 and 2005, inflation was pretty benign. It was at 4%, but the stock market gave very good returns. The Sensex was up 19%. The next 5-year period, 2006-2010, inflation was high. It was more than double. It was at 9%. And yet the returns were lower as compared to the previous 5-year period. Consider the next 5-year period, inflation again at 8%, which would have meant that the stocks should have also gone up by 8% or more. Instead, Sensex returns were just 5%. 2016-20, same story. Inflation 5%, but Sensex gave 13% returns. So the assumption that stocks have an inbuilt protection against inflation, I think, is on very shaky ground. It is not inflation that is moving the stock market. It seems to be something else. Inflation does not impact stock performance. So if you're thinking that inflation is going to go up in the future, therefore you should move more money into stocks, perhaps you could do well to take a look at this data point. Over a short-term period, over a period of 3 to 5 years, it is the starting valuation multiples and the earnings growth that the Sensex companies or the stock market records, that is a more important parameter than the inflation. If the inflation is high, but if the Sensex is attractively valued and if the Sensex companies are growing their earnings at a good pace, then the stock markets will give good returns. On the other hand, if the inflation is high, but the Sensex is expensively valued and the Sensex earnings are also not growing at a pretty fast clip, then even in a high inflation environment, stocks are not guaranteed to give you good returns. So your stock market strategy, whether it be high inflation or low inflation, should, I think, depend more upon what the stock market valuation is and what the Sensex earnings are going to grow at. Now, there have been many 3-year, 5-year, 10-year periods where Sensex returns have been poor. They have not been able to, beat the inflation, and therefore, if you are investing from a 3-year perspective, 5-year perspective, you should be very careful of moving 100% of your corpus into stocks, because there is no guarantee that even if the inflation is high, the stock market would prove to be a great defense against inflation. The strategy that I'd like to follow is, see, if you have 100 rupees right now, put 50 rupees into an FD or a bond, good quality bond, and 50 rupees into the stock market. And at the end of the 1-year period, if the 50 rupees in the stock market has, in a low cost index fund has become more, its share has gone up to significantly more than 50%, you rebalance, bring it down to 50%. On the other hand, if the bond component has gone up significantly, the stock market has fallen, then you again rebalance by moving money out of bonds and putting it back into stocks. This is the ideal strategy to follow in my view, because the returns from the stock market over a 3 to 5 year period are not guaranteed to be better than the inflation rate. They are determined more by the starting price to earnings multiples and the earnings growth. Now, there is a very strong temptation to try and put more money into stocks if the inflation is going up, especially after what has happened in the last 1.5 years. You've seen FD rates go down a great deal. FD rates are 5-6% right now, which is even lower than the historical rate of 8%. And the stock market has done phenomenally well, you know, since the March of 2020, where I think it has more than doubled. But this does not happen every year. If you are thinking that stock markets, investing in stocks could give you 30, 40, 50% returns every year, then it's a wrong assumption. The right strategy right now, if inflation is coming, would be to actually not invest, not take a huge exposure to stocks, but have a 50-50 kind of an approach where even if the stock market does not do well for the next 1 year or 2 years, you have that money in bonds which will give you some kind of returns. On the other hand, if the stock market continues to do well, then you have that 50% which will continue to give you returns. But putting entire money into stocks is not what I would suggest, especially at the current elevated valuation levels. So whether it be high inflation or low inflation does not matter. Stocks are a better bet against inflation, but you also have to take into account the valuations and the underlying earnings growth. And the best strategy, according to me, is keep toggling between stocks and bonds, so that you book profits, some amount of profits after every rise in the market, and you put more money into stocks after every significant fall, which I think is the right thing to do from a long-term perspective. So forget the inflation, have a sound strategy, and keep following that strategy is what my suggestion would be in the current environment. So do let me know what you think of this suggestion, whether it makes sense to you. Do keep your feedbacks and comments coming. They are very important to us. So do keep it coming, guys, and I'll see you again next time. Thank you so much.
Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before